In this video, you're going to learn how to set up a strategy that combines the MACD, RSI, and stochastic indicators, review its past performance, and whether it's profitable to trade this strategy in today's market. MACD is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. The RSI aims to signal whether a market is considered to be overbought or oversold in relation to recent price levels, whereas the stochastic oscillator is a momentum indicator comparing a particular closing price of a security to a range of its prices over a certain period of time. From their definition, we already know that all three indicators are tracking the momentum of price. However, they use price to perform their own calculations, so sometimes their signals could be conflicting. Traders might be confused on how to use them properly. First, let's set up our indicators. For MACD settings, we'll ditch the old parameters and use 8 period for the fast line, 21 for the slow line, and 5 for the signal line. For RSI settings, we'll use the default setting of 14 period. A gentle reminder that RSI range between 0 to 100, we'll use 50 as a key level to determine the direction of a trend. For stochastic indicator settings, we'll also use the default values. K line is set to 14, and D line is set to 3. So how are we going to combine all three indicators and have them work in harmony? Our entry rules for long is when the RSI crosses over 50, the stochastic indicator's fast line crossed over the slow line, and the MACD line has crossed over the signal line. The entry rules for short is when the RSI crosses under 50, the stochastic indicator's fast line crossed under the slow line, and the MACD line has crossed under the signal line. Our exit rules for stop loss for a long position is when the price dropped below the recent pivot low. For a short position, if the price rise above the recent pivot high, we exit the trade. I use the last 20 bars highest high and lowest low as our pivots in this testing. Otherwise, we'll exit the trade when there is an opposite signal. Before recording this video, I've already tested the strategy and noticed it is most profitable when trading the 1-hour time frame, therefore we'll be trading on the 1-hour chart. We first start off by reviewing the performance of this strategy on the 18 major currency pairs. Change our time frame to H1 and we're ready to go. We quickly skim through the profit factor for each pair. I can see that only Australian dollar to Japanese yen pair is profitable. Let's move on to stocks. In summary, the strategy is profitable on Australian dollar to Japanese yen pair, Tesla, Apple, Twitter, and Amazon, on the 1-hour time frame. Of course, there will be much more assets that can be traded with this strategy profitably. I suggest viewers treat it as a source of inspiration for you to develop your own trading strategy. Savvy traders should test it before implementing it live and optimize the parameter further to match with the assets that you're trading. And there you have it. I've shared the trading strategies with guidelines on how and where to trade it. If you want to learn more about other profitable trading strategies, click like and subscribe to my channel. Leave a comment below if you have any questions or suggestions on strategies you want me to review in the coming videos. Thanks for watching and see you soon.